This LOS is Explain Arbitrage and the role it plays in determining prices and promoting market efficiency. The role of arbitrage. Arbitrage is possible when two securities or portfolios have identical future payoffs but different market prices. Arbitrage is the condition that two equivalent assets or derivatives or combinations of assets and derivatives sell for different prices, leading to an opportunity to buy at the low price and sell at the high price, thereby earning a risk-free profit without committing any capital. I put that into bold green. That's important with regards to the definition of arbitrage. It leads to an opportunity to earn a risk-free profit without committing any capital. That's important, okay? Trading by arbitrageurs will continue until they affect supply and demand enough to bring asset prices to efficient no arbitrage levels. And the combined actions of arbitrageurs bring about a convergence of prices. Hence, arbitrage leads to the law of one price. Transactions that produce equivalent results must sell for equivalent prices. Now, the text has got a long section working through an example with a lot of calculations. That's not exactly required with regards to this learning outcome statement, because this learning outcome statement is only to explain arbitrage and the role it plays in determining prices, okay? So for this LOS, we're not going to go through a detailed numerical example. We're just going to do a series of practice questions, and that should be good enough to get you up to speed for any questions on the CFA exam with regards to explaining arbitrage and the role it plays in determining prices and promoting market efficiency. So as I said, sometimes the best way to learn is just to scroll through a bunch of practice questions and pick up the learnings from the solutions. And that's what we're going to do. We're going to do a series of practice questions to finish this learning outcome statement. The first one, which of the following is a result of arbitrage? A, the law of one price, B, the law of similar prices, or C, the law of limited profitability? Okay, I almost had to laugh when I was reading B, the law of similar prices. That's clearly not right. Now I will laugh. A is correct. Arbitrage forces equivalent assets to have a single price. There is nothing called the law of similar prices or the law of limited profitability. And again, sometimes there's something in an answer on the CFA exam and you don't know what you don't know, and you don't know it because it's made up. So there is no law of similar prices. There is no law of limited, and that's why I said you always got to go with your gut. You know that the following is a result of arbitrage. It's the law of one price. Next practice question. When an arbitrage opportunity exists, what happens in the market? A, the combined actions of all arbitrageurs force the prices to converge. B, the combined actions of arbitrageurs result in a locked limit situation. Or C, the combined actions of all arbitrageurs result in sustained profits to all. I think that was another pretty easy question. When an arbitrage opportunity exists, what happens in the market? Well, it's the combined actions of all arbitrageurs force the prices to converge, and that's why we get the law of one price. So A is correct. Price converge because of the heavy demand for the cheaper asset and the heavy supply of the more expensive asset. Profits are not sustained. In fact, they are eradicated as prices converge. And locked limit is a condition in the futures market. It has nothing to do with arbitrage. So that was just kind of mumbo jumbo in there, and B meant to confuse you. Another quick question. The law of one price is best described as A, the true fundamental value of an asset, B, earning a risk-free profit without committing any capital, or C, two assets that will produce the same cash flows in the future must sell for equivalent prices. Again, I think a fairly easy one. The law of one price is best described as two assets that will produce the same cash flows in the future must sell for equivalent prices. Okay, the law of one price occurs when market participants engage in arbitrage activities so that identical assets sell for the same price in different markets. Another quick practice question. Which of the following accurately defines arbitrage? So again, these are all definitions. A, an opportunity to make a profit at no risk. B, an opportunity to make a profit at no risk with the investment of no capital. Or C, an opportunity to earn a return in excess of the return appropriate for the risk assumed. Again, if you've been paying attention, I don't think that question is too difficult, because recall on the previous slide we had that arbitrage is a condition that two equivalent assets or derivatives or combinations of assets and derivatives sell for different prices, leading to an opportunity to buy at the low price, sell at the high price, thereby earning a risk-free profit without committing any capital. So which of the following accurately defines arbitrage? It's B, an opportunity to make a profit at no risk and with the investment of no capital. B is correct. An opportunity to profit at no risk could merely describe the purchase of a risk-free asset. An opportunity to earn a return in excess of the return appropriate for the risk assumed is a concept studied in portfolio management and is often referred to as an abnormal return. It is certainly desirable, but is hardly an arbitrage because it requires the assumption of risk and the investment of capital. So arbitrage is risk-free and requires no capital because selling the overpriced asset produces the funds to buy the underpriced asset. And one last practice question to finish this LOS. Which of the following ways best describes how arbitrage contributes to market efficiency? A, arbitrage penalizes those who trade too rapidly. B, arbitrage equalizes the risks taken by all market participants. Or C, arbitrage improves the rate at which prices converge to their relative fair values. And that's a nice one to end on. C is correct. Arbitrage imposes no penalties on rapid trading. In fact, it tends to reward those who trade rapidly to take advantage of arbitrage opportunities. Arbitrage has no effect of equalizing risk among market participants. Arbitrage does result in an acceleration of price convergence to fair values relative to instruments with equivalent payoffs. And that's the last slide for this LOS. Thank you.